Hi guys, welcome to another episode of AA Finance Solutions Uncut, where we talk about finance and property unfiltered and uncut. Today we have a very special guest, someone who have a background in economics, who has over 20 years in the banking industry. He's a top ex senior banker at Westpac 2 years in a row. He is our own BDM / finance broker, Mr. Gerard Tham.
Yeah. Thank you for having me, Leonard. Thank you for inviting me to the uncut session. But I'm not sure if I need to be here because I'm not circumcised. So, Leonard, what are we talking about today? I have to take a very, busy schedule at Channel 9.
Thank you. Thank you very much. Thank you for spending your time.
Thank you.
So today we were talking about a very hot topic at the moment, which is talking about interest rate.
Ooh.
I think that's been at the back of everyone's mind at the moment, given how things are going. So I guess what we want to know is we just want to get a bit of your professional opinion about some of the topics surrounding interest rate. How does that sound?
That's a very big topic, and yes, it has been the focus and front of mind for a lot of home borrowers at the moment. Me, you, and I'm sure everybody else as well, especially with the rate last couple of rate rises. Especially the last one was a bit chunky one at 0.5. I don't think a lot of people anticipated that.
That's really crazy, isn't it?
Big jump and that quick. So, interest rate rise, just a quick overview, seeing I've got a degree in economics and trying to blow my trumpet. It is otherwise known as a monetary policy set by the RBA, Reserve Bank of Australia. So the objective of increasing or decreasing interest rates is to regulate economic activity, to curb spending or to expand spending, depending on which way the government wants the economy to go. Absolutely. So if inflation's too high, property prices are too high. If prices are too high, they will increase interest rate to pull things back a bit. Or as we've seen 2 years ago, due to COVID and things were slowing down, interest rates was dropped to try to curb, boost the economy. So
now I think I've got a lot of questions from my clients here with regards to fixing or staying variable at the moment. So, I mean, given the current circumstances, like what do you reckon will be the right choice?
Well, let's have a look at what rates are doing at the moment. So this is a question to you, Leonard. What is the average variable rate in the market today versus the average fixed rate in the market today? What sort of rates are we looking at?
Yeah, it's a good question. So roughly for an owner-occupied 80% lending, for 2 years fixed, you should be looking at around 3.94%.
Yep.
And for the variable, you should be looking at the low 2%, but because of the rate rise last month, so you should be looking at the mid around the 2.6, 2.7% for the variable.
What we're seeing now is actually quite interesting. Now, don't forget, I've been working in the bank for a while, and traditionally, it's always been fixed rate has always been lower than the variable rate. Okay, so the reason why is because they put fixed rates lower because the lower rate is an incentive for the customer to actually consider taking on the fixed rates. However, now we're seeing the total reverse opposite, where it's the fixed rate is actually much higher than the variable rate. On average, there is a disparity about 1% between the fixed rate and the variable rate, where the variable rate is where the fixed rate is actually more expensive. So, I guess one of the things to consider is, well, do we go fixed now, or do we leave it as variable? So a lot of questions are being asked, but the trend of questions being asked is, should I fix my rate now? And my response to the customer is, mate, you've missed the run. You've missed the run now. The fixed rates were actually increases since December last year. Now, this wasn't on the media, this wasn't spoken about, but the banks were pushing up fixed rates already from December, January, February. I can think of Westpac as probably one of the leading culprits. I mean, they were pushing fixed rates up 4 or 5 times over the last 8 weeks around the beginning of the year. And a lot of banks were starting to follow suit as well. So now when interest rates have gone up, customers now are asking the question, should I fix it? Well, the answer is you should have fixed it 6 months ago, 6 to 12 months ago, when fixed rates have bottomed, but now it's already too expensive. So for example, let's say if you were on a variable rate, let's say 2.8% for argument's sake, yeah, and fixed rates on 3.8. If you do decide to fix it now, so instead of paying 2.8, you're paying 3.8 from today onwards. And let's say if you fix it for 2 years at 3.8%, and the disparity is like I mentioned is 1% higher, you're going to ask yourself, well, in the next couple of years, do I see interest rates increasing that much for me to actually put myself in a better position? It's a tough question because irregardless is, if you do decide to fix it now, make no mistake, you are paying a higher rate of interest as of today and for the next couple of years for the time that you fixed it.
I think that makes perfect sense.
So Leonard, are you fixed or variable?
Unfortunately, I'm on variable at the moment, and I've just got in the news yesterday that my mortgage was going to go up by 0.75, so that's going to hurt, definitely.
Well, I've been lucky. I took on the 4-year fixed rate for Bankwest, and that was last year. They were still offering 4 years at 1.99. So the way that I was thinking was, well, how low can the rates go? Well, back then, official cash rate was 0.25. Can't get any lower. The banks can't drop the rates any lower because they've got overheads and costs and staff and insurance and all that to pay for. So I took sort of like a calculated guess, and it obviously has paid off well. So I'm not going to feel the pain, or not as much, until 3 years from today. So I guess what I'm trying to suggest is now, these comments will probably lead on to the other question. So I'll just pull it back. And let's look at the next question that you've got on the list, and then we can expand it a bit more.
So the next question that I have for you is that, okay, so now we know that the interest rate is going to go up. So the question is, in your opinion, how do we ease the pain of the raising of the interest rate?
Well, this is the question that that everyone can ask themselves. I mean, I ask myself that question. It's that there's no magic answer to that. It's very simple. Is we have to all spend less. That is the purpose of monetary policy. That is the purpose of the Reserve Government, where they increase interest rates, is to curb spending, to make the economy, or to make households spend less. Why? Because the cost of funding or cost of borrowing is much higher. So that means your pay packet that you have, you've got less to be able to spend it on discretionary things like going to restaurants, going to the movies, or in some case for you single men, like having a couple of sugar babies on the side, or going to karaoke's and all that stuff. So you spend less on all those activities, on all those, non-essential, but you also curb stuff on essential stuff. So things like food, you still have to eat, right? But you probably go out less to restaurants, and you probably cook more at home. I'm doing it, I'm thinking twice about going out and spending money unnecessarily. Why? Because things are quite expensive now. In my case, if my fixed rate expires, I'm going to be put from a lower rate to a much higher rate. I don't want to wait till my fixed term expires. I'm trying to save up now, trying to build that buffer,
Correct, yeah.
I guess one of the things, this is a very critical time for you to consider your loans, where you are at now. So this is where us as brokers come in, where we come in and give you options above and beyond what a single bank can give you. Okay, one bank can give you only information on their products, whereas we can provide you with an array of options. Yeah. So this is what I've been telling my customers now. If you are on a high rate from an old product that you've done a few years ago, you could be on a variable rate, but you're on a high variable rate now. The impact of you at a higher base, when the rates do rise, the impact on you will be much greater than to someone starting at a cheaper, lower rate, at a lower base. So if interest rates go up, you're not as heavily impacted as those on higher rates. So this, I do actually encourage all customers or all homeowners, anyone with mortgages, to come and sit down, have a chat to your mortgage broker. Come and give Leonard a call. He's very experienced, or anyone within our team, and we can discuss with you what we can do, because there are still some banks out there that can offer you quite sharp rates, because it's very competitive still out there. There are also non-traditional bank lenders out there, the smaller lenders, the second-tier lenders, They can offer cheaper rates. Why? Because they have less branches, or they have no branches, less staff, less overheads. They can pass on the savings to you. But on top of that as well, we can actually negotiate a cheaper rate for you directly with the banks than you probably could do yourself. So to ease the pain of interest rate rise, start with your home loan first and come and speak to your broker.
Definitely. I think that's the benefit of speaking for people like us, where we can give them the options, and save the money.
Absolutely.
All right, to the next question. So I think it's sort of like a follow up from the second one. Like what do you think the impact of the rate rise towards property?
Rate rises. Okay, with the Reserve Bank increasing official cash rates, interest rates, and the bank increasing the rates as well, there is always a correlation between interest rates and asset prices. When I say asset prices, it's a very broad term. It includes things like property, share markets, and all that stuff. Yeah. When interest rates go up, what happens is the cost of credit is more expensive. People borrow less, okay, because it's costing more. Business invest less as well. So then there's less money. Property price will drop. Share market will drop. Let me just cast your. Okay, I'm not sure when you're going to be viewing this podcast, but today is the 14th?
15.
The 15th, yeah? Today is the 15th. So on yesterday, the 14th of June, if you decide you want to have a look, just Google stock market, the 14th of Jan. The share markets across the world all took a smashing. Well, I'm not saying smashing. Sorry, the ASX, Australian share market, took a massive hit yesterday. Billions of dollars were wiped out because the interest rates rise for a couple of days ago was announced. So, people are fearing that economy will slow down. So people were offloading a lot of shares. So you can see how interest rates gone up. Share market took a massive hit yesterday. The rate rise of 0.25 from last month, the East Coast like Sydney and Melbourne, property price were already registering a drop. The only state to buck the trend was WA. Yeah. Now with the 0.5, you will find that WA will either slow or start to downturn a little bit. Hope not, but like I say, you can't sort of deny what the trend is, or at least human behaviors when it comes to interest rate rise. So this is what I think will happen, but this is only one factor. There's other factors as well. Yeah, you've got mining boom. Now mining boom, we deal with a bit of FIFO customers, for example, or people that service the mining industry. Mining is taking a boom, Leonard. Okay, things are actually going very strong. Mine sites are opening. A lot of people are coming from East Coast to WA, in particular WA. I know, I've got a good friend that's an Uber driver, and he said the amount of people that he's picking up in the airport, new people coming to FIFO. Irish people are coming in, okay? Overseas people are coming in as well to work in the mine site. So you're going to get migration, whether it's temporary migration or permanent migration, okay? That's going to, again, the demand's going to surge and push demand. So you're going to get a few factors that's going to be push and pull. But I think WA will be a bit unique compared to the East Coast. Its property prices aren't that ridiculous anyway compared to Sydney and Melbourne. So I find that maybe this time around, the impact on WA property prices may not be significant when you compare to our cousins in the East Coast.
I agree.
So it may flatten, it may just slightly increase, or it may be slightly decrease. But I think it will still be quite flat though.
I just came from Sydney last week, and talking to a few brokers in Sydney, they're telling me exactly the same thing like what you said. I think they're sort of starting to feel the downturn at the moment in terms of the property prices, because there's not as many people going to the home opens. They didn't get as many offers. So it's interesting. But that was a good point on WA.
And look, to be honest, we're still seeing people coming in with offer and acceptance with contracts or sales for property. So people are still buying. It may not be as hot as before, but the demand is still there. Okay.
100%.
Yeah.
Alrighty, last question
for
today. So I guess this is like everyone's guess. We don't have a crystal ball, but in your opinion, or in your professional opinion, like how much of how much of the increase of the rate rise is going to be for end of this year? Like, how much more do you reckon?
Ooh, now this is a very interesting topic. Yeah. Now, what has caused this interest rate rise? Wow, it's really the injection of all these funds into the economy through different various sources, and I'm talking about billions and billions of dollars here, that has caused us to be where we are in this position now. So cast our minds back, not very far ago, 2 years ago, let's say from March to June 2020 onwards, yeah. What have you got? What sort of stimulus did you have? You had the JobKeeper, you've got the ATO cash boost, you've got the SME small recovery loans for small businesses, yeah, where they can borrow money. They don't need security, it's backed by the government, okay? You've got the federal home builder grants, you've got the WA building bonus, okay? You've got the superannuation withdrawals. You know, you could withdraw 10K from your super if you can show hardship, okay? You've got the ATO as well with deferred tax. You've got the home loan repayment holidays. Remember? I'm not sure. I think a lot of you would have rang up the bank and says, hey, I've been impacted. Can I take 6 months and not pay my home loans and put me on hold and I can repay after that? A lot of people took that as well. So you can imagine that all this cash and all these monies were made available in this economy. So when the lockdown happened, we expected a lot. When people started taking like those 6 months off repayments, we expected property prices to crash. You know, after 6 months, what happened if people don't have a job? They can't, you know, small business not going to have the customers. They're going to have to sell the home. There's going to be foreclosures. We sort of looked at that. But the reverse happened. There was so much funds, so much activity that property prices went up. Went up, you know, 15%, 20%, 25%, okay? And this was all domestic demand. Nothing to do with international buyers. They weren't coming in, they were locked out. So, with all this activity that has driven up the economic activity here, now interest rates are going up to try to curb that, you know, that effect from all those stimulus and all that.
Yeah.
So to be honest with you, this recent couple of rate rises, it's actually just a drop in the ocean. Yeah, it's not gonna impact that too much. There's still a lot of money in this economy. Yeah. And the other factor to consider, now this is something that you probably won't read about in the papers, is that a large portion of people have fixed their loans before this rate rise. Yeah, because back in mid 2020 onwards, traditionally, banks would do about 15% of their mortgages in fixed rates. During 2020 onwards, that 15% became 50%. So banks were doing a lot of fixed rates, not just new customers, you know, wanting to refinance. Existing customers were ringing up the banks to say, hey guys, you know what? I'm not refinancing, but can you just fix my existing rate? Yeah, no problem. So with these rate rises that has happened, it's going to impact those on variable rates because their rates will go up. But guess what? A huge percentage of the population aren't going to be impacted by this rate rise at all. Why? It doesn't matter if interest rates go up to 10% next year. You know, I'm still paying 1.99%. Okay, so that means technically is I could still go out and spend and further drive demand for goods and services here. However, I think, you know, given the fact that this group or portion of people aren't affected, okay, so one thing could happen is maybe the Reserve Bank needs to push up the rates even higher, you know, and impact those that are on variable rates. I don't know. This is quite a tough question to ask. But what I predict is that until this group of people come off their fixed rates in the next 2 or 3 years, we might not see reserve banks dropping rates until then. So between now to the next 2 to 3 years, we might see the trend of increasing interest rates to continue before it peaks and drop maybe 2 or 3 years after from today. So my best advice is, even if you're on fixed rates, you got to just, you know, behave as if it's impacting you a lot. You got to start saving up, putting money aside, because you know what? Once that 1.99 fixed rate ends, bang, you could be on 5% or 6%. You got to have savings in the background. You got to start preparing yourself. This is a wake-up call. You know, a lot of households have been spending too much. Let's all tighten up the little budget now, you know, and just watch what we spend. Things, you know, as you know, things move in cycle. interest rates aren't going to be, super high or super low forever. Things will always move in an 8 to 10 year cycle. Yeah. So let this ride. It may continue 2 or 3 years. I don't know. I hope not. Okay. But all you could do is, if you're on fixed rates, just watch your spending. If you're on variable rates, speak to your broker, and let's see if we can do you a better deal.
I think you summed it up really nicely. I think we did a bit of a research before we go into the show. This is back, historically, back in 2008, just with the mining boom and all of that in WA. The current inflation was similar as well to what we are now, so which is around the 5.1, and the Reserve Bank did increase the interest rate up to around 7%. So hopefully
that meant
be the case.
So 7.25% was the official cash rate.
Correct.
So the banks were charging you 9% for your home loan.
Yeah.
Now, if I had to pay 9% now, I'll be homeless, living in a cardboard box. So, I don't think it will get to that stage. I think the government's watching very close, because normal households were all carrying a lot more debt than we were in 2008. Yeah. But, you know what? I don't think anything bad comes out from just being a bit more frugal, Leonard.
Absolutely.
I think being frugal is good.
I agree.
Yeah, just watch what you spend.
Definitely. So I think if we can summarize it, 3 key take point from today is be frugal.
Be frugal. Speak to your broker.
Speak to your brokers. But home
Options,
loan
yep.
options. Yep.
I don't know what the third one is. Third one is, I come here for coffee because it's free. I don't go to Mas because it costs me $6.
Thank you so much, Gerard. I think that
welcome.
was very interesting to hear all of that from you. And for all of the viewers out there, if they want to reach out to you, what would be the best way to do that?
Call him. Give me a call, 0415 94 881. That's my work mobile and my personal mobile. So if you call me, you'll get me.
All right, guys. Thank you so much for listening to that episode of AA Finance Solutions Uncut. I hope you enjoyed as much as I do. That was really interesting. A lot of information, a lot of good information, especially coming from the mouth of Mr. Gerard Tham, the Mr. Kuku Chow himself.
Hey, thank you.
So, thank you so much for listening, and I hope that we can see you guys again next week. Thank you very much.
Thank you. Bye.